Monica, and welcome to this lecture recording of capital budgeting. Some call it investment appraisal, but please note that this recording is a 2-lecture series. So do make sure that after watching this part 1, take time to watch part 2 of this lecture session. So our learning objectives from this session are: you need to be able to set out the reasons why capital budgeting is critical. So here effectively we are saying you need to know the why, the answer to the why question. Why do we do capital budgeting? We then also need to understand the importance of cash flows rather than accounting earnings for capital budgeting purposes. So you find that in your financial accounting, you've got your earnings that you calculate or determine using your IFRS. But within financial management or investment decision, we want to make use of cash flows. Then another thing that you need to be able to do is to define the different type of investment projects, and then also being able to apply and explain different techniques used to evaluate projects. Then also as part of our learning outcomes, you need to be able to discuss the advantages and disadvantages of each particular technique. Then, most important, you need to be able to determine the cash flows that are relevant to a capital budgeting decision. So you're going to find that you're going to spend a bit of time discussing the cash flows that are relevant in capital budgeting decisions. Then you should also be able to take into account tax implications as part of capital budgeting. Because as you may know, tax is a real cash cost. So you need to know how it affects capital budgeting. So, and also understand the role of post audits in capital budgeting. Because you need to know when you're doing capital budgeting, we are trying to estimate or predict the future. Definitely, we can never 100% predict the future. So let's say after you're done with the project, we need to evaluate how good was our estimation. What did we do right and what did we do wrong? Which is the purpose of post audits. So what is capital budgeting? So then, like I said at the beginning, some people call capital budgeting investment appraisal. So if you look at financial management, we've got 3 core decisions: the investment decision, the financing decision. So when you look at the investment decision, we are saying when I put my money into a project, as an investor or as a company, I expect a return from that amount. So capital budgeting is simply saying I need to analyze and evaluate an investment project before I commit my funds. So effectively in capital budgeting, we need to be able to determine the expected returns from our investments. And also within capital budgeting, we expect that the project will give us returns over a number of years. So what does this mean? It means we're going to be looking at projects of a longer term, that's the medium to long term. So examples could be acquisition of plant and equipment. We want to buy a piece of plant and equipment. Definitely, if we look at the nature of the equipment, we expect to earn a return from that equipment over a period of time. Or we want to open a new retail outlet. Or we want to start a new marketing campaign. So all those things will give us returns over a period of time. So what does this mean? For example, when I'm looking at a decision to make to invest in inventory, we're not going to use capital budgeting techniques. Why? Because when we look at inventory, we expect our returns within a period of, say, normally less than a year. So definitely that's not part of our investment or capital budgeting appraisal decision making. So looking at investments, we need to know the different types of investment projects that can be undertaken by an entity. And why is this important? Because you need to know when should I start to think about capital budgeting. So it can be an exam scenario when you are given information. So the moment you pick a type of project like this, in your mind then you should know there's a possibility of me thinking about capital budgeting. So examples include replacement or expansion. So you find most businesses, or if you look at most equipment, they will useful lives. So towards the end of the useful life of assets, most businesses then start to say, okay, we now need to replace this piece of equipment. But in making that replacement decision, we need to make sure that the equipment we are going to buy, we are going to be able to earn a return, which is the reason why we then need to do capital budgeting. Or we want to expand our capacity. So the question is, if we do expand, are we going to earn a viable return? And also, we can use these in capital investment projects whereby we are looking at independent or mutually exclusive projects. So what does an independent project entail? It means this is a project if we are evaluating it in its own individual capacity. Your decision to invest in it or not is not affected by any other project. But mutually exclusive, you find that you are looking at, say, two projects, and your decision to accept project A is affected by project B. So it means, for example, if you accept project A, you will be able to accept project B. And in that case, we are getting to make use of capital budgeting techniques. Then you also have what we call divisible and indivisible projects. So divisible is saying, let's say the entire life of the project is 10 years. Can we roll out that project in piecemeal or in stages? Indivisible says you can't break it down. It's either you're in or you're out. So we're going to discuss all those types of projects. Now the question is, what techniques can we use to evaluate our investment projects or our capital projects? So the most popular or common one is the NPV, which we are going to discuss in detail. The internal rate of return, the payback method, accounting rate of return, discounted payback, modified internal rate of return, profitability index, as well as the economic value added. So in the next couple of slides, we're going to be discussing how each method works as part of capital budgeting. So starting off with the NPV. So the key question in NPV is, should we or should we not? But ultimately, we want to make a decision. Should we put our money into this project? So the decision is either we're going to put our money or we are not going to put our money. So how does NPV work? So NPV is simply saying we are taking the future project expected cash flows, which are then discounted at the cost of the capital, or it can be discounted at the weighted average cost of capital for the business, with the idea that if the net present value of our cash flow is positive, we are saying effectively we are going to make money. That is, if NPV is less than 0, we are going to accept the project. Why? Because we are getting a positive return from our investment. But if our net present value is less than 0, that is, we are getting a negative return, definitely it means we are not going to make money from this project. Therefore, we should not be accepting the project. So in principle, that's how an NPV works. So you need your projected future cash flow, and then you need a discounting factor to get your net return. So looking at this simple example, we have put our cash flows starting from the year 0 cash flow. So the year 0 cash flow is the initial investment that we need to put into the project. So in this example, I've got 10,000. Then in year 1, we're expecting a net cash flow of 8,000. In year 2, we're expecting net cash flow of 6,000. So I'm now saying, looking at over the life of the project and then discounting this at 14%, we're expecting net present value of 1,600. So if you look at that decision-making matrix, it means this project, because it's giving us a positive NPV, we are going to accept the project. So in its simplistic form, that's how net present value works. It's part of capital budgeting. But when you're not using this tool, what are some of the key issues you need to be aware of? So the first thing is, we said we are going to be discounting future cash flows. So your ability to be able to identify those future cash flows is very critical. If I've got information that I will give, let's say it's an exam situation, am I able to identify the relevant cash flows that I need for me to be able to do my NPV calculation? So in part 2 of this lecture recording, we are going to be discussing various types of cash flows and some of the issues you need to take into account as part of determining whether or not they are relevant for your NPV determination. Then the next key issue you need to be cognizant of is which rate of return should you use to discount these future cash flows. So in fact that ordinarily in capital budgeting, and when you're using the NPV method, we tend to use the weighted average cost of capital of the entities. But in some case studies, they can give you the cost of capital specifically for that project. If it is given, you can make use of that specific discounting factor. The another thing you need to be aware of as part of the NPV, you need to be aware that the NPV is sensitive to the changes in the discount rate. So discuss more in terms of if the discount rate is higher or is lower, what does it mean to the net present value as part of sensitivity analysis. So looking at this graph, I'm sure you can see that with a discounting factor of say 3%, we are getting an NPV of above 3,000. But the greater our discounting factor becomes, I'm sure you can see our net present value goes down. So which means if we are expecting a higher return from the project, it has a direct impact on the net present value. It means chances of us not reaching a positive NPV are higher. Looking at this particular graph. Then the next method that we can use in capital budgeting is the internal rate of return. So if we look at the NPV, we say the NPV, we are discounting future cash flows. And I'm saying it's going to be based on if positive NPV accept, if negative NPV reject. So how does the IRR work? So the IRR we are saying is yet we don't know the return that we are going to get from these projects. So the IRR then gives us the discount rate that equates the PV of the expected future cash flow to the initial outflows. So effectively, the internal rate of return is the discount rate or the return that will give us an NPV of 0. So what does this mean? When I'm looking at the IRR, I'm saying for this project to make sense to me, I need to look at the IRR. What about the IRR? I need to be able to compare it to my cost of capital or my required return on the project. If my required return is lower than the IRR, my decision is I'm going to accept. But if my required return is lower, so it is higher than the IRR calculated, I'm not going to take the project. So how do you calculate the internal rate of return? I know most of you have got your financial calculators. In your financial calculators, you've got your IRR function, or in practice, people tend to use more of the Excel function. But the key thing is for the IRR to work, you need your cash flows. So your cash flows in this example, I've got 10,000 initial outlay, year 1, 8,000, year 2, 6,000. So if you then use your IRR function in your calculator, you should be able to get an IRR of 27.2%. So now the question is, when you now compare the NPV or IRR, how do they work? So you find for independent projects, the NPV and the IRR normally give the same accept or reject decision. And we will explain first how that works. However, we are looking at mutual exclusive projects. So mutual exclusive, what do we mean by this? I have project A and project B. If I accept A, I can't accept B. If I accept B, I can accept A. So when I calculate two projects, IRR, and two projects, NPV. So in NPV, if I calculate the NPV for project A and B, and they are both positive, the NPV method says both projects are acceptable. Then, if I calculate using the IRR gives me different items. IRR normally I say I pick the project with the higher internal rate of return. So it's fine that. However, this problem will then come into play when you put projects with different lifespans. What is the implication? The time of the cash flows will differ, and the IRR will also not be equal to the cost of capital. So making use of the IRR or NPV in terms of mutually exclusive projects can then become a problem. So, how do we solve this problem? So if you look at our cash flows, and you are saying the timing and size of our cash flows differ. So if you look at our examples, you have project E and project F. So here, yes, the period is the same, it's a 3-year period, but the timing of the cash flows is different. So if you look at this, project A is giving a higher IRR of 14.2%. and project F is giving an IRR of 26%. And here we say our cost of capital is 10%. So because both projects are giving an IRR of above 10%, ordinarily we should accept both of them. But if we then look at this, it's also saying F, however, F is a higher IRR at 26%. It's only higher. Why? Because F's cash flows are coming in earlier in the project life, that is in year 1 and 2, 80,050. But for project E, they're coming later into the project's life, which is why F is giving a higher IRR. So it finds that this may result in the fact that the time of cash flows differing is making us come to a different decision. Yet on a net basis, these two projects are giving us the same return if you use the NPV approach. So next step, we are going to go to part 2 of this lecture recording, where we are going to continue discussing the other methods that can be used as part of capital budgeting. Thank you for watching this lecture, and see you in part 2 of this lecture recording.